Good morning and welcome to the Saxo Bank Morning Call. It is Wednesday, January 23rd, 2019. And at the top of the program, I actually want to talk about our quarter one outlook, which we published yesterday. Our theme, as we talk about on the slide here, is the global policy panic, the reaction to what, of course, the darkening clouds across the world in terms of the economic outlook, and how we have this interaction with the market, hoping for that big reaction from policymakers, as we've seen to a degree with the Fed and their softening on their forward rhetoric, and how it could engineer some degree of confidence, but that actually the majority of the downturn in markets comes as authorities are in the cycle of easing, precisely because the conditions are so weak. That was the pattern back in 2007 and 8 for sure. Clearly something was coming undone in the U.S., but the market actually topped out after the Fed actually was actively easing rates. And I think, Ola, we've talked about this a lot, that gold is going to be one of the most interesting asset classes next year, or this year, now that it's 2019, especially compared to the very many boring years we've come out of, as the market looks at how we weigh policy panic and trust in the authorities.
Absolutely.
And gold is sort of the flip side of that.
Yeah, because we've had 4 or 5 years here with good returns in stock markets. During that time, gold has been trading sideways, no interest. It's been volatile at times, but generally range bound. We are still range bound. We're still stuck in this range, so we need to go another almost $100 to the upside before we break out. But yes, the big move up in December was a combination of the big fall in stocks, but also the emerging the emerging panic. You can almost argue at the Fed. So the main risk probably to gold on that basis right now is if we have cooked in too much dovishness in the FOMC. So that's really where we should focus as well.
All right, so look for that on home.saxo, all the quarter one now, look, the text itself, and of course a number of short videos on how we see the path unfolding from here. Now, back to the day-to-day, we had a weak session in the U.S. Equity markets yesterday, following on from a weak start in Asia. As we see on the chart here, we've pretty much established with this rejection of the previous day's bar the worst day almost since the bottom established at the very end of December last year. The weak sentiment coming clearly on the risks to trade talks between the U.S. and China. The latest development is that the U.S. has canceled some lower-level talks that could have happened this week. 2 officials that were headed to Washington, they've canceled those talks ahead of what was supposed to be higher-level talks next week with the Liu He, the bigger vice premier, the bigger authority, and what was hoped to be, preparation for a bigger deal. So market's not liking that, and we're seeing a weak risk sentiment. I don't see how we get back to a rally stance here unless we see something very promising on that front, or unless we see an end to this government shutdown, or both, if you will. We're not seeing any thawing on that front either. And then overnight,
if you could just mention that, and if we look at something like grain markets, we're basically desperately lacking data from the U.S. in terms of exports, so in how the markets are moving there. So the main input right now is these trade talks, and we saw that as well in some of the key crops yesterday. We had these gyrating markets; they are reacting very much to these trade talk news. So that's really the key driver right now.
Yeah. So, also some of and as well the positioning reports on the COT report out of the futures exchange in the U.S. Supposedly a lot of the data being delayed, and we have seen some delays, but the existing home sales, for example, was released yesterday, although some thought it would be delayed, and was very weak. So this may be adding a bit to the negative sentiment. We have new home sales today. We'll get to that later. In the meantime, overnight we had the Bank of Japan. And not a massive surprise, as usual. They continue with their supposedly expansion of 80 trillion yen yearly, but their de facto expansion is far lower than that and decreasing as they're actually tapering the rate of purchases. Nonetheless, they lowered the inflation forecast once again, and I believe it was the chunkiest lowering of that inflation for the cycle. The fiscal 2019, so the fiscal year starting in April, that year-on-year forecast lowered to 0.9% from 1.4%, a massive chunk there. And, again, the Bank of Japan failing all tests of credibility on reaching that inflation target. Somehow the market cobbling together a reaction. We did see yen a bit weaker overnight. Matthias, on the options front, this event risk was not played with much anticipation.
No, market doesn't really bother about yen at all at the moment, and we see vols coming a little bit lower.
Is there still some residual, aggravation, or vol still a little bit higher from that residual crazy December market we had in yen crosses?
Yeah, but we've seen a big correction from the crash in beginning of January, and we're still trading a little bit higher than where it should be. But I mean, it's slowly coming lower.
Right. I would still argue, though, that yen crosses remain a proxy of risk appetite if we are seeing a bigger turnaround in risk sentiment with topping out in the global equities, and if we're not showing progress towards a trade deal. The other action overnight, I would say excessive reaction to what was a rather small data surprise. The New Zealand Q4 CPI surprised to the downside, only 0.1%. But as we see on the chart here, Aussie Kiwi really coming in for a drubbing. I think people caught wrong-footed by what looked like a potential break higher that we've talked about a lot recently, about 106, 106.25. That was partly in play as well, the CPI surprise, of course. But I think there's a China element here as well, because Australia is far more exposed in trade relations with China than New Zealand is. And the negative sentiment linked to China worries affecting Aussie more quickly than Kiwi. So I would be surprised if that's the establishing a dramatic new trend there. Now, speaking of event risk, we have an ECB meeting up tomorrow. Another one, Matthias, that we're seeing some anticipation of it, a lot more than the Bank of Japan certainly, but looking at Eurodollar 1 month falls, it doesn't look like the market is really looking for something dramatic to be set in motion here.
No, well, the ECB event in itself is priced a little bit higher than normal. So we see market expect...
but very short-term stuff, right?
That's overnight. So market expect a move of like 60, 65 pips overnight. But as you say, the underlying volatility in 1 month is still trading very low.
We have your chart here from Bloomberg showing the black, the implied volatility is getting towards the low range of the last many months, and I think the Eurodollar arguably even lower than that if you look at just the Eurodollar. Yeah. And then the realized vol is coming down as well.
Yeah, so this is the currency VIX, the basket of the biggest currencies. So we see quite a big drop in implied volatilities over the last couple of weeks, and that's mainly sterling vols that's coming lower. But realized volatility is on the low, but still a little bit higher than we saw at the end of last year in October.
Are you seeing a lot of pickup in interest, or is there there's a skew picking up in favor of the sterling calls now that we're seeing sterling starting to rally here?
As usual, when market is trying to sell volatility in sterling, but they want the hedges, so they're buying the low delta calls or puts for that matter. So we see a more even distribution between the puts and calls now than we did ahead of the vote.
Okay.
So, but low delta calls is still in demand.
Yeah, still a very difficult situation to call there, as we're seeing May is really continuing to attempt to insist that she will not eliminate the risk of a no deal, but the cabinet, even her own cabinet, is getting very upset about that, as it's pretty clear there's a consensus among parliamentarians against risking a no deal cliff edge on March 29th. So we'll look for a vote early next week on Brexit and on her Brexit Plan B, and whether we get this no-deal elimination that many are beginning to price in. Finally, on the implied vol front and options, you've been talking a lot about Huff lately. There's been a pretty interesting disconnect between what the CPI data shows and the central bank there is doing.
Yeah, so I mean, as I said, vols is trading lower in general, and especially emerging vols have been trading a lot lower over the last week. In exception is Huff. So if you look at the chart, you can see that we have had quite a big move in Euro Huff, relative terms for Euro Huff at least, and broken out of the recent range and broken down between well below 320. So you can see on the blue line there we have a quite good pickup in volatility, and up to 5% roughly now in the 1 month. So we had a miss in CPI a week ago, and then we had a hawkish central bank that triggered this move lower.
Interesting to see that Hungarian foreign strength there, and as well as we head into 2019, all the talks of EU existential risks and how the EU approaches the very different style, with the Orban government and the Polish government, and those existential risks, and the threat of EU funding being eventually pulled, although that's not for the budget until out in 2021 for the new EU budget cycle. Ola, we talked about gold. You also talked about silver. You've been focusing a lot on this big cyclical broad terms because of the extensive valuation difference between silver and gold. And now we've had a rally and gold in favor of silver, but now it looks like it's turning back lower potentially.
Yeah, I think it's just, I just want to highlight with this, because generally in commodities right now, we are generally sideways trading. There's not a lot going on, but what we've seen in gold here and silver over the last couple of days, we found a base once again in gold down towards this 1380 level, and the pickup we saw yesterday immediately attracts some renewed interest in silver. So this is the gold-silver ratio. So when that goes down, silver goes up relatively to gold. So just basically highlighting, if we see renewed bids coming into the precious metals here, then silver is likely to be the outperformer.
You talk about low volatility in commodities. Day traders in front nat gas months, so seeing plenty of volatility.
Yeah, it's been a crazy season for natural gas. Just take a look at the chart here. It really has been a winter where weather forecasts have been changing on a weekly basis.
And this is U.S. Just to point out,
this is U.S. natural gas, yeah. And we can see we've been trading since the early November. We've been trading between below 3, and we've traded almost up to 5. And all the gaps has happened on Mondays when the weather forecast has been changing over the weekend. We saw that again this week, where Monday kicked off with a big sell-off, and that extended into yesterday. So just to highlight, just since the early November, we've had out of these 55 trading days, we've had 20 days with ranges of daily changes of more than 5%. 5 of those have been above 10%. So it's not for the faint-hearted.
No. And the interesting thing being that basically what we're seeing here is a $3 gas price, and that's effectively what it is in the forward months as well. So we've simply, even despite some pretty impressive cold weather forecast here, they're so secure in the projections for supply that the curve has just been crushed to flat.
Absolutely, and record production is still the outlook for 2019. And as soon as we get closer to the end of this winter, the market, if we exit the winter these kind of levels, then there is a risk we could move down towards the 280, because the market is simply, they expect that the inventories will be built quite rapidly into the spring.
Just an amazing phenomenon, the shale gas in the U.S., the ability to continue to increase production there. Let's get to our earnings calendar. We have, I don't have a lot of intelligence here on the numbers. We had that NIDEC report overnight, a Japanese company, a lot of exports there into China. They had a recent warning. They've managed to avoid a lot of carnage overnight. They announced a buyback and attempted to shore up the forecast. So I think the negative on the day was only about 1.5%. Later in the day, we have Ford Motor. There's been a lot of negative sentiment in the automotive sector, so it'll be interesting to see how the market spins that. And a big company like UTX. And then tomorrow, I think it's interesting with the big Intel report and how they are looking at forward demand, one of the biggest, of course, chip companies. And then tomorrow, for the economic data points, we have Canadian retail sales today. And then tonight, the Australian employment data, which could get a bit of reaction, even though this is terribly lagging stuff. And the interesting thing is tomorrow's twofold. Those flash PMI surveys, both manufacturing and services across the Eurozone, always interesting, those. And then the ECB meeting and whether Draghi is ready to pull out more explicit talks of what the easing will look like if easing is on the way. There's a lot of talk of a new TLTRO program to shore up lending in the credit market from banks, or if this is merely sort of softening up the forward guidance and the intent to eventually hike rates and expressing a more two-way willingness. So we're a bit leaning on the potential for a euro negative price action in the wake of that, but let's see what Draghi delivers, and we'll have more on that tomorrow. For now, that's it for today. We'll be back tomorrow with the Saxo Bank Morning Call.